The One Big Beautiful Bill Act, OBBA, shifts the landscape for year-end tax planning. The law has significant implications for some of the most tried-and-true tax reduction measures. It also creates new opportunities for businesses to reduce their 2025 tax liability before December 31st. Here are potentially some of the most beneficial ones. Investments in capital assets. Thanks to bonus depreciation, businesses have commonly turned to year-end capital asset purchases to cut their taxes. The OBBB helps make this strategy even more powerful for 2025. Under the Tax Cuts and Jobs Act, TCJA, 100% first-year bonus depreciation declined by 20 percentage points each year beginning in 2023, falling to 40% in 2025. The OBBBA restores and makes permanent 100% bonus depreciation for qualified new and used assets acquired and placed in service after January 19, 2025. Qualified purchases made in 2025 on or before January 19 remain subject to the 40% limit. The law also boosts the Section 179 expensing election limit for small and mid-sized businesses to $2.5 million, with the phase-out threshold lifted to $4 million. Both amounts will be adjusted annually for inflation. Most assets eligible for bonus depreciation also qualify for Section 179 expensing. But Section 179 expensing is allowed for certain expenses not eligible for bonus depreciation, specifically roofs, HVAC equipment, fire protection and alarm systems, and security systems for non-residential real property, as well as depreciable personal property use, predominantly in connection with furnishing lodging. Section 179 expensing is subject to several limitations that don't apply to first-year bonus depreciation, especially for S corporations, partnerships, and limited liability companies treated as partnerships for tax purposes. So, when assets are eligible for either break, claiming allowable 100% first-year bonus depreciation may be beneficial. However, Section 179 expensing is more flexible. You can take it on an asset-by-asset basis. With bonus depreciation, you have to take it for an entire class of assets, for example, all MACR 7-year property. Business vehicles are popular year-end purchases to boost depreciation-related tax breaks. They're generally eligible for bonus depreciation and Section 179 expensing, but keep in mind that they're subject to additional rules and limits. Also, if a vehicle is used for both business and personal use, the associated expenses, including depreciation, must be allocated between deductible business use and non-deductible personal use. As an added perk, the OBBBA changes the business interest deduction, specifically the calculation of adjusted taxable income, which could allow you to deduct more interest on capital purchases beginning in 2025. Pass-through entity tax deduction. Dozens of states enacted pass-through entity tax (PTET) deduction laws in response to the TCJA's $10,000 limit on the federal deduction for state and local taxes, SALT, also referred to as the SALT cap. The mechanics vary, but the deductions generally let pass-through entities, partnerships, limited liability companies, and S corporations pay an elective entity-level state tax on business income with an offsetting tax benefit for the owners. The organization deducts the full payment as a business expense. Before year-end, it's important to review whether a PTET deduction is available to you, and, if so, whether it'll make sense to claim it. This can impact other year-end tax planning strategies. The PTET deduction may be less relevant for 2025 because the OBBBA temporarily boosts the SALT cap to $40,000, with 1% increases each year through 2029. The higher cap is subject to phase-outs based on Modified Adjusted Gross Income, MAGI. When MAGI reaches $600,000, the $10,000 cap applies. But the PTET deduction may still be worthwhile in some circumstances. It could pay off, for example, if an owner's MAGI excludes the owner from benefiting from the higher cap, or if an owner's standard deduction would exceed his or her itemized deductions, so the owner wouldn't benefit from the SALT deduction. By reducing the income passed through from the business, a PTET deduction election could also help an owner reduce his or her liability for self-employment taxes and avoid the 3.8% net investment income tax. Moreover, lower income could unlock eligibility for other tax breaks, such as deductions for rental losses and the child tax credit. Bear in mind, though, that while a PTET deduction could help you qualify for the Section 109(a) Qualified Business Income (QBI) deduction despite the income limit, see below, it also might reduce the size of the deduction. QBI deduction. Eligible pass-through entity owners can deduct up to 20% of their QBI, whether they itemize deductions or take the standard deduction. QBI refers to the net amount of income, gains, deductions, and losses, excluding reasonable compensation, certain investments, and payments to partners for services rendered. The deduction is subject to limitations based on taxable income, and in some cases on W-2 wages paid and the unadjusted basis of qualified property, generally, the purchase price of tangible depreciable property held at the end of the tax year. The OBBBA expands the phase-in ranges for those limits so that more taxpayers will qualify for larger QBI deductions beginning in 2026. In the meantime, you can still take steps to increase your QBI deduction for 2025. For example, if your income might be high enough that you'll be subject to the W-2 wage or qualified property limit, you could increase your W-2 wages or purchase qualified property. Timing tactics. Generally, accelerating expenses into this year and deferring income into 2026 might also help you avoid income limits on the deduction. Research and experimental deduction. The OBBBA makes welcome changes to the research and experimental RNAMP-TE deduction. It allows businesses to capitalize domestic Section 174 costs and amortize them over 5 years beginning in 2025. It also permits small businesses, those with average annual gross receipts of $31 million or less for the previous 3 tax years, to claim the RNAMP deduction retroactive to 2022. And businesses of any size that incurred domestic RNAMP expenses in 2022 through 2024 can elect to accelerate the remaining deductions over either a 1 or 2 year period. You don't necessarily need to take steps before year-end to benefit from these changes. But it's important to consider how claiming larger RNAMP deductions on your 2025 return could impact your overall year-end planning strategies. It's also a good idea to start thinking about how you'll approach the RNAMP expense deduction on your 2025 tax return. For example, it might make more sense to continue to amortize your qualified RNAMP expenses. You also should determine if it would be beneficial to recover remaining unamortized RNAMP expenses in 2025 or prorate the expenses across 2025 and 2026. And if you're eligible to claim retroactive deductions, review your RNAMP expenses for 2022 through 2024 to decide whether it would be beneficial to do so. Don't delay. We've focused on year-end strategies affected by the OBBBA, but there are also strategies not significantly impacted by it that are still valuable. One example is accelerating deductible expenses into 2025 and deferring income to 2026, or doing the opposite if you expect to be in a higher tax bracket next year. Another is increasing retirement plan contributions or setting up a retirement plan if you don't have one. Now is the time to execute the last-minute strategies that will trim your business's 2025 taxes. We can help you identify the ones that fit your situation.